All right, we're going to try something new today. I wanted to take a look at a short setup that I put in place today, May 6, 2020, using put options on the QQQ ETF, which is the Nasdaq market leaders. It includes funds such as Apple, Microsoft, Amazon, Tesla, NVIDIA, a lot of names that people know well that performed very well during the secular bull market previous to the pandemic. It was actually moving very strongly in the upward direction. When the pandemic started to affect the US, we saw a pretty swift drop, followed by a retracement of about 61 to 62%. Then another drop. This entire move was about a 30.5% drop in just 23 trading days. Very significant drop. Since then, we have moved up, quite a bit in just 31 trading days. We have made back, you can take the measurement from the highs to the current price, which is here. We've made back all but 7.5%. So, I mean, you're talking almost 25% gains since the drop if you bought at the very bottom. Many investors just held through this. Some of them unfortunately sold down here. One way or another, this move has been very volatile, and that is often a opportunity for profit for short-term traders like me. So what I'm looking at here is basically a very similar move to what I put in place back here in the early March. So what happened back then was the pandemic was realized, and we had a very quick drop. The drop was, let me try to check here, it was about 16.5%, so pretty significant considering that we hadn't made a drop like that in over a year. But what was really impressive, which was how quickly it bounced off the 200 moving average and made a really strong retracement. I mean, we're talking 50%, more than a 50% retracement in a matter of days, just a week, to make that retracement here. So after that, everyone started to think, well, maybe this will continue. Maybe this bull market is so strong that it can handle a pandemic. Of course, that wasn't true. Instead, we got a much bigger drop before we got to the previous lows in late March. Since then, we've bounced back quite a bit, like I mentioned, and what do you know? We are returning to test that same area on the chart. So this is a very significant spot on the chart due to that, because there are a lot of people, including me, who sold here and made money. And so those same traders, as well as investors who got out here and then are considering, what to do now if they bought back already, there will be a lot of people selling here. However, there are also a lot of people who are buying. You can see the volume here. There's more selling, sell bars, red bars than green bars. So there's more big sellers than big buyers, other than the very lows. But there are definitely some folks who bought the dip here, or who even bought breakouts. This bar here is pretty large compared to the previous sell bars. So this day was quite a few buyers. We had lots of gaps too. You can see these overnight moves where there's gaps between the close of one day and the open of another day. So those are just little traps inside of the week that basically forced some short side traders to buy just so they don't lose more money. One way or another, what I see here is an opportunity for a high odds limited loss trade. So using what's known as naked put options, so buying the puts without owning the actual fund, I can profit if the price does drop. It would not have to drop to the lows for me to make money with this trade. In fact, I break even if we make only let's take a look here, about an 8% drop between now and July 16th. I would lose less or make more were we to drop sooner than later. That's important to know. Timing is extremely important when it comes to options. And I've also set up the point where I would exit the trade at a loss. The reason you do this ahead of time is because when it actually occurs, it's very common to mentally, psychologically convince yourself that you should hold on even though you're wrong or just early. But with options contracts, the price, as the price moves against you on the underlying, in this case the QQQ ETF, my options value decreases exponentially. So you don't want to be holding when you think you may be wrong, because were I to hold these contracts, these put options, through expiration on July 16th, the options would be completely worthless and I would lose 100% of the cost of those contracts. Now the good news is that's the max loss I can make. Even if QQQ, if every company went out of business somehow in the QQQ and this fund went to zero, I would still only lose the price of the contract. So that's important to understand. The loss is limited even if I don't do anything to the cost of the contracts. But my plan is by figuring out in a month from now where price would have to go for my contracts to lose half their value. How wrong would I have to be for these contracts to lose 50% of their value? It puts me at about just under 2% gains on the fund, and that is about 225 or so. So if QQQ continues to rise and breaks over 225 before June 5th, I will be able to exit for a loss that's tolerable to me, an amount that I have decided I'm willing to lose on this high odds, low risk play. This is my potential loss. Were it to happen sooner, I could actually get out at a higher price. For me, the value would be more and I wouldn't lose 50%, but I would be completely comfortable with my risk. Considering the odds of this trade working, I would be comfortable exiting here for 50% loss. That's important to understand. This is the strike price, 210. So notice I'm choosing a price that is right around the 61.8% Fibonacci retracement number. This is part of the strategy that I use. I feel that the chances that we return to test this price are extremely high, and whether or not we fall below it before or after July 17th is really what will determine whether or not I get paid. I have no doubt in my mind that we will return to this price. I'm trying to make a wager, you could say, that it's going to happen within the next 2 months. So if it goes lower than that and drops to 200 within the first 2 months, I could get out of my trade without losing anything. So you can see that time really does matter for options, because if this occurs, this 4% drop occurs within the next month before June 5th, I could exit this trade and double my money. But if it takes until July 5th to do it, I would actually lose some money on the trade, even though it's the same amount. That is the frustrating part, and the part that most people don't understand about options is that time matters almost as much as price. So again, were I to hold it till expiration, July 16th, I could lose up to, the fund could lose up to 8.5%, which sounds like a lot. And even though I'm getting paid for the price falling, if it takes 2 months for that to happen, I actually don't make any money. I just get out scot-free. They give me back my money, basically, at an 8% loss, right? So for this trade to really work, this drop has to happen before the expiration, not on it. The earlier it happens, the more I get paid. So when on the next video, I'm going to take a look at how much I would be risking and how much the trade would profit based on where the price is at a given date. My targets in general, based on the chart and what I expect to happen, again, when it happens is the hardest part to determine. That it will happen eventually is not as hard as it seems. My first target would be this break-even point where I could get rid of some of the contracts were it to happen quickly, because then it would be much more than break-even. In fact, like I said, I would double my money if it happened within the next month. My next target is way down here, and the reason it's a target at around 180 to 185 is because of this point on the chart where we ran into resistance when we tried to bounce right at first and then made a lower low and then broke through it. And you can see that while we came back and tested this one, we never came back and made sure that this was still, that there were more buyers than sellers there. And if you go back in time, this was also a really important price point here. This was between August to October of 2019. And at this point, there were a lot of people very concerned about the trade war and things like that. And then all of a sudden, price broke out exponentially. So these same sellers here, same buyers here who made this money showed up here to make this money. And you would expect that they would show up again if we were to drop there. You'd think so. But if they don't, the next point that I expect buyers to show up based on this similar pattern we saw in January of 2019, the December drop followed by this V recovery. Very, very similar pattern to this. If you see it, this one is just quicker and not as extreme. But when we did that, we never came back to test this. So on the V, it's basically the neckline of this V. You can see that we never came back and tested it. Never did. So it would be very normal to come back, test it, and bounce. So what I'm saying is that we could make a lower low than the March low and find buyers 30% from this point, today's price. We could still drop 30% only to find buyers and continue the bull market. That is possible. I don't think it's very likely, but it is possible. So were that to happen, we would be looking at about a 160 or so target. So let's remember those numbers. We've got a target at 200, a target at 180 to 185, and a target from 155 to 160. Those are the three areas that I'd be, again, targeting with a short-sided trade. So let's take a look at the trading platform Tastyworks, where it gives me an analysis of how much these puts would be worth at different dates and different prices to see whether or not this trade makes sense. All right, see you soon.